We are taking Diwali to another level, and we are not only talking to domestic investors who've got a great pulse on the markets, but we also thought of somebody who's looked at India while investing in Asia quite meaningfully over the last number of years. Their allocation to India was lower, and they've picked up the allocation now. I'm talking about Santa Lucia Asset Management, and the CEO of Santa Lucia Asset Management, a fund based out of Singapore, Florian Weidinger, spoke to us earlier in our studios, clad in the Diwali attire. It's a conversation you don't want to miss. This is the Worldview Diwali special. I wonder if this festive season, from an Indian purview or an Indian view, seems festive enough in light of the fact that the world is an uncertain place in general, one Truth Social post away from uncertainty, and India has its own share of issues, notably with the US. So how do you see India and the Asian landscape, considering that you are a large investor in the Asian equities?
Well, I mean, festivals are a good moment to forget a little bit the world around us. So, your prompt is, of course, right. Not only has India had a rough patch geopolitically, but also, if you look at the equity market, it's sort of I think it's the biggest quarterly underperformance against Asian equities in 14 years. You have still a very strong domestic buyer base in the Indian equity market, but the foreigners have kept taking money out. And this has its own reasons, valuation and so on, but really going back to the global picture, it's been an interesting few months. I think a lot of people took the India-US relationship for granted. I think that applies both to people in India as well as people in the US. We can all make jokes that it's one Truth Social post or two individuals dancing with each other, but the echoes that came from the decision of the US to essentially levy 25 plus 25 equal 50 tariffs on India is not something that's easy to walk back from tomorrow. So yeah, this I think will have more lasting consequences. And we chatted earlier on the way walking here to the studio. I mean, during some of our travels covering companies across Asia, we spoke a lot about tariffs and what it means for them. And one of the executives of a big textile outsourcer company had told us that we look at factories in Vietnam, in Indonesia, in Bangladesh. Thank God we didn't go to India, was his quote, in the face of that announcement.
Yeah. So what is, to your mind, okay, let me first broaden the horizon for Asian equities, because there is this uncertainty, not just with India, with a host of other countries, China, a few others, etc., right? And there is this whole moment wherein the gold price uptake is telling you is that the world seems to be worried about whether it is geopolitics around impounding assets of a particular nation or nations impounding assets of other nations, so to say, the way it happened last 2 days ago, and more. So what is your central thought when you think about investing in the equity markets and Asian equity markets in particular?
Oh, that's a very interesting thought. I think, I mean, first of all, I'm a German national sitting in Singapore investing in Asia, but I've been sort of out of Germany for 25 years, and I'm an OCI. So I like to think of myself as somewhat in the middle on this topic. And I think that, I mean, look, for us who invest in Asian equities, the strength of the dollar has been a big headwind for 15 years, right? The opportunities in Asia and India notwithstanding, dollar strength has subtracted from everybody's returns. But we may be entering a period where dollar strength can maybe no longer taken for granted because there's a counter reaction, right? People call it the debasement trade, metals rallying, gold, silver. It is probably fair to say some of this is occurring in response to some of the actions the West consciously took. This is not about passing judgment on morals and right and wrong. It's just factual that the West chose to weaponize the monetary system, chose to weaponize US dollar bank account holdings in its pursuit of Russia, partially in its pursuit of China, in a sort of big power game. And we can all theorize why and how and whether it's right and wrong. But the fact remains that sort of the key concept of sort of private property and, most important, due process, that things don't happen to you until there's a legalistic judgment, that has called into question, I think, the validity of, if you're an Asian tycoon, do you really want to keep all your money in US dollars? That's sort of question number one. And then question number two, based on what's been transpiring in the US with We've seen the ascent of Miran to the FOMC, and he is the author of the famous paper that suggested that instead of paying interest on treasuries, maybe treasuries should be charged a usage fee as a home for global funds in US dollars. And so as these ideas take hold, it doesn't take much, right? There's about 17 trillion of foreign US equity holdings in US equities. A lot of that is from Asia. There is trillions more in US treasuries. And just a little bit of that money starting to think maybe I need to go elsewhere, and some of that market could be in my home region. That would represent, in relative terms, a very big portion of funds that could be looking for an alternative home. And this is not an end of the world conversation. It's just a gradual adjustment. It's somebody who has 100% of their assets in US dollars deciding, well, maybe I need to keep 20% somewhere else. And I think that's where some of the gold buying is coming from by both tycoons and central banks.
Yeah. Well, Jeff Gundlach saying that, hey, look at it, and I would like to move away from all my dollar holdings into something else. But so if you are, I know you are an FI which invests in India, but let's say you are an FI investing across the world. One school of thought, Florian, is that over the next 5 years, yes, the world grows, but the rest of the world, non-US, grows at a much faster clip than the US. Maybe the dollar depreciates gradually as it may be, but in a linear fashion over the next 5 years. What does that mean for fund flows to the rest of the world versus the US? And does that therefore create a good problem for Asian currencies and Asian equity markets?
That is certainly a possibility. I mean, I think as investors, we need to look at what are the possibilities, not what are we hoping for. And while this possibility sounds a little bit like what we're all hoping for, it is becoming a more probable part of the distribution of outcomes. And there are a few things here that you have hinted at, I think, in your question, which is, first of all, you'll have investors reassessing for the first time after many years where there was this famous TINA, there is no alternative, right? And we're seeing this year for the first time allocators who allocate to us saying to us, we are actually subtracting from the US. I haven't heard this in years. So this is something that is starting. The second thing that's starting is that the weakness in the dollar is coinciding with an acceleration of fiscal expansion in the United States. It's coinciding with growth actually slowing relative, as you're saying. And it also comes at a time when everybody's focused on the trade war and the negative headlines, but also coming at a time when the US's net flow from its foreign investment position is turning negative for the first time in many, many years. So the US always had this deficit with the rest of the world as a stock measure, but miraculously had positive net flows from its foreign holdings. Economists have called this dark matter, and that dark matter effect has started to turn neutral roughly this year. So it's an interesting moment. All these headlines are happening at the same time that the net foreign investment flow position is starting to turn neutral from a surplus. So therefore, it's reasonable to say, well, the range of possible outcomes, the outcome where there's a stalling dollar, not a collapse, just a stalling dollar, is something that gets a higher probability assignment from here on. And
therefore, a high probability of a fair degree, I mean, the last two answers, do they indicate a higher probability of flows into emerging market assets over the next 5 years?
Well, that's, again, a hope and a higher possibility. I mean, if you take this year, given everything you've been reading, you would think this should be the turning point. And we have heard a lot of people taking money a bit out of US equities and putting it elsewhere. Actually, excluding China and Taiwan until very recently, I mean, Taiwan was sort of net flow zero for most of the year. It's now positive 6 billion, I think, year to date. Net flows into Asia are still negative this year. And this is despite the dollar actually weakening and so on. Net flows into every single major Asian equity market are net negative cumulative this year. India, I think, is minus 17 billion. And that's the foreign flow, of course. The domestic flow is very strong, 7 billion monthly domestic mutual fund insurance flowing in. So that story is intact. But the foreign flow into India is negative. The foreign flow into every other Asian equity market is negative. The only exception is actually Hong Kong, which has a lot of the southbound money from mainland China flowing into Hong Kong. So that's actually the interesting story, that despite everything you're seeing, we're still seeing net outflows, and we're coming, depending on which country you pick, most Asian equity markets are in a position where their foreign investment position is back where it was 10, 15, 20 years ago.
Yeah.
So Indonesia as far as I can tell, all-time low. Thailand, I think, is back to 2012 or something like that. We're talking very sort of low foreign investor positioning in the rest of Asia, and so a little bit of that money flowing back could be quite positive for these markets, therefore.
So is that happening because of Max 7 and gold, or are there other reasons for it? And therefore, it's not that an Indian investor looking at the FI positioning in India at multi-year lows is alone. It's happening across, and therefore it's not an exception to the rule, but rather the rule right now.
Absolutely. I mean, India is the biggest bucket within that, absolutely. But yes, it's true for almost every Asian equity market, that net negative flow this year. And if you look at over many years, actually.
Got it.
However, all good things come to an end, all bad things come to an end. And we're starting to see the configuration where there's a possibility that you'll see some neutral or maybe positive flows into some Asian markets. Taiwan turned positive, I think, in September.
Okay, yeah, and now what? The second highest weightage on the emerging market index, if I'm not wrong, after China, eclipsing India. The other question, Florian, is that when does the dime on India turn? Is it that a foreign investor, let's say for you, for example, right, would you wait for 2 or 3 key events? Would you wait predominantly for some bit of resolution between India and US? Would that be the, if not the sufficient condition, but a necessary one? Would you wait for growth to finally show up because a lot of measures have been taken, and we'll talk about that? Or would it be something else that would make you say that, okay, let me now turn and invest into India, if you are not already?
I mean, for us, we're quite specialized value investors at SLAM, so we invest in single situations. So we are less driven by a country view. We're always driven by the single situation. And I think in India, even in this configuration right now, there are a few interesting corners that have been neglected over many years. Indian investors have been quite growth obsessed, if I may use that word. And we actually quite like, we started to pay more attention over this year into some of the medium-sized InvITs in India, which I know are not popular at all, other than with pension funds. But they're actually offering very interesting risk compensation on a spread to sovereign, which you don't find in other international markets. So that asset class just seems the wrong price relative to how other assets like this are trading in other markets in the world.
Got it.
I like to joke that, you know, sort of, let's say, take the highways. The highways are the highway InvITs are trading at IRRs that are double to triple the implied IRR of roads in China. So it's probably the only asset where India is cheaper than China. Right? Otherwise, Chinese equities are cheaper than Indian equities in almost every sector. And so, so we just significantly increased our allocation to InvITs this month in India as a result of just a view on the sovereign spread being very high. And on a singular basis, a lot of these companies are just trading quite cheap. But as a more general country view, I think you're right that you need to see a little bit of resolution on the geopolitical front for especially the manufacturing export-led to see a bit of light. I mean, nobody wants to think about FDI and 50% tariff land. And then the other thing I think is that, and that's going in India's favor actually, is that the dollar stalling is giving a country like India, also actually maybe Indonesia and the Philippines are in that category in Asia, quite a bit more policy space on the interest rate, right? So as the US dollar is no longer exerting pressure, central bankers in places like India, Indonesia can manage their own economy a bit more and worry a bit less about the exchange rate. And so that actually creates policy space. And you've seen, you know, RBI coming down, you know, 25, 25, 50, and there's a pause right now, but you could argue based on inflation readings and so on, there's potentially room for more, right? And that's quite a new configuration for India, which used to be sort of high rate, high inflation. India turning into sort of moderate inflation, moderate rate. That gives an interesting thesis for assets that are still producing reasonably okay growth in the broader Asian context.
It'll be interesting to see how the composition of the nominal growth changes in real growth and inflation dynamics. But just before we get to that and the special individual things, so if you were a top-down investor, would you wait for the India-US truce to be the key factor? Or would it be that even if that were to exist, but if earnings growth in India picks up because of all the measures that the government has taken, that gives you some comfort? Yeah,
I mean, I think you need to be, if you want to really make money, you have to be in there before the truth, right? Because of markets. So I think following fundamentals that's the school of investors we belong to. So we would follow the fundamentals. And the macro is a game that we all need to take just as a given. Right? The macro is not something we can influence. The macro is something we're a price taker in the macro game.
Okay, so you want to be the price maker, and therefore you want to look at value currently.
Yeah.
Okay, if indeed, okay, would you be enthused to allocate more to India from where you are right now in your overall Asia allocation, if indeed the whole consumption spend effort that the government has taken starts to result in earnings growth and GDP growth? There are some people penciling in that from this 6.25, 6.5% growth, circa, or between 6 to 7% growth, you might actually nudge 7.5 if all of these measures come to the fore next year. If that happens, would you increase your allocation to India?
I mean, we are coming from a low base at the moment. I mean, we had almost a quarter of our flagship fund in India 2 years ago.
Wow.
We're in particular in the power companies, but we had, we reached, I think, middle of this year, we were at a low of 5% or so of the flagship fund. So we went from being very heavy in India to very low in India. And
good call.
We're currently inching up. So that was in early 24, somewhat lucky based on individual holdings, but we have been buying, we have probably been adding 200, 300 basis points to India over the last few weeks. Simply because that, if you look, India is always an expensive market, but worst quarter in 14 years, valuation premium relative to EM is starting to normalize a bit. Is this market really going to trade at a PE of sub 20 in aggregate? Probably not. So it's probably not a bad time because there's a lot of bad news out there, and bad news out there is usually a time when you want to be more marginally interested than disinterested. That's frankly why I'm here. I'm meeting with companies to understand what's below the carnage, and those are interesting moments to look usually.
What have you learned thus far?
I mean, it's only day 2 of the tour, but and I have another 2 days to go of meeting companies. But I think it's fair to say that. And by the way, I think this is true across Asia. I think there's a great deal of improvement. And you asked me earlier, what would investors need to see? And I think that's maybe the most important dimension for Asian equities and Indian equities, which is the quality of the treatment of minority shareholders. Right? So, and there's an effort across Asia, which the Japanese have been leading, which, believe it or not, the Chinese have been quite strong in. And the Koreans, which is to really push companies to do the right thing for all shareholders. Some of it through carrots, some of it through sticks. You might have heard the Value Up program in Korea. I'm sure you've heard about the whole Topics Index in Japan. China started with the SOEs and is widening it. They published in November last year the so-called 9 points. Everything in China comes with a number. And that sort of rolled out what they learned from the SOEs into all companies, and a few companies have followed up with various so-called market value management measures. You see the JUMP program in Thailand. Singapore is trying to revive its equity market. India is trying a bit with its own POEs over the last few years. I mean, we've seen the news on banks, but also earlier efforts to make POEs more professional. I think India still is lagging, frankly, the rest of the region in really holding promoters to account and creating a basically level playing field for all investors. And I think a lot of international investors are always concerned about the inherent asymmetry between a dominating shareholder and a minority shareholder. This doesn't have to do with, you know, is one person a good person or a bad person? It's really more, it's always a conflict. Even for the good person, it can be a conflict, right? You know, take Unilever India, right? I mean, a majority shareholder can abuse minorities even if the parent is called Unilever, right? So, and it can certainly happen with a single promoter. It can happen with the state. And that's really what we look for at the moment in Asia, is in which regions do we see that companies are succeeding in becoming a bit more shareholder friendly. And shareholder friendly meaning that, you know, capital allocation is transparent, evidence of cash flow being shared. India is lagging the region a lot when it comes to dividends and share buybacks, right? So there's.
Would you want that? Wouldn't you want Indian companies to actually invest in growth right now, as opposed to dividends and buybacks?
Well, if as long as growth is uncertain, investors do like to see some evidence of capital discipline, right?
Yeah.
And the important thing about a little bit of capital return is that it disciplines a board that has to think once a quarter. How much of this money do we retain? How much do we give to all shareholders? How much of the money goes to the cousin through the related party transaction? Capital return disciplines these conversations. Okay. And that's why it's, in our belief, a very important element. And I think a lot of international investors are looking for evidence of better capital management across EM. And that's an area where India has been lagging a little bit.
Got it. Okay, now on to themes. So you told us about InvITs, right? That's something that you like. India doesn't have an AI story worth tom-tomming about. But there are a few interesting themes that have opened up in the last 3-4 years. Energy transition,
Yes.
Some bit of data centers, power demand, so on and so forth,
Absolutely.
right? What do you like?
Yeah, I mean, this is a very headline top-down, of course, for the brevity of the conversation, but I think we structurally like the Indian power sector. We're not heavily positioned in there right now, but if you just compare broad numbers, right, on television, it's always dangerous to cite precise numbers, but in ballpark terms, India is looking at about 400 to 500 gigawatt of generation capacity, right? China is close to 3,000. So just to get orders of magnitude right, and you know the recently announced project in Tibet is going to add another 60 gigawatt to that number. So 15% of India is being added with an announcement out of China, right? So and that's of course China's great play over the last few decades is to become the manufacturing center for the world. They need a lot of power supply for that, but China has a lot of excess power, so it's very well positioned from an AI point of view as well. And AI is ultimately going to be a power game. India is coming a bit from behind there. It shares that with most of the other South Asian nations and Southeast Asian nations. Vietnam has made good strides in building power ahead of industrial demand over the last 10 years, and that strategy really worked. You see what it did for the FDI numbers. So Vietnam and Thailand actually both drove a very conscious power development plan that emphasized building power capacity and then letting the manufacturing come, not waiting for the manufacturing announcements and then building the power plant. But India actually has a few aces up its sleeve. World's biggest hydro reserves, right? So a lot underutilized. I mean, India could close a lot of its power gap with investing more into hydro. There are some stock market ways to be exposed to that in India. So the hydro opportunity in India is interesting because that seems the renewables the most logical way for India to close its power gap, and really the differential in the numbers. If India wants to be a serious player, it can't be in a configuration where China has almost 9 times the power generation capacity of India.
Okay, so energy transition or power demand per se is
Absolutely.
one thing. What else? What else within India? Top down.
Yeah, and we are. This is more of a sort of an opportunistic thing,
Sure.
but we are looking at. As a value investor, we're always interested in where's the misunderstanding, where's the pain. That got us into the road assets recently because you had accidents there, right? You had the ILFS drama and so on. Earlier, our interest in the power sector was created by a lot of the working capital issues and debt problems in the sector. So we're always attracted to where's the pain, because that might be an opportunity to buy something cheap. And I think in India, an interesting area to follow, although it comes with, unfortunately, a lot of personal issues as well, is the rise in household debt, which is still okay, actually, in very big terms. I mean, if you compare India to Indonesia, for example, Thailand, then India's household debt level is high, but it's not excessive. I mean, Thailand is running at a much higher. I think India went from roughly 30 plus to 40 plus% household debt to GDP, right? Thailand is running closer to 80. Indonesia is a bit below. But let's just agree, it's a bit too high for comfort, and it's starting to subtract from household spending ability, and that's why also the whole consumer story is not so straightforward in India, because that subtracts. But at the same time, there's sometimes opportunity for companies that are in that space and are feeling a bit the pinch on increased credit costs and so on. Might be interesting companies to follow.